Good morning, my name is Sona and my student ID is 5919496. So the first CAF question explains the asset pricing model. Starting off with the capital asset pricing model is a single factor model where the risk factors consider the investors. They compare the systematic risk to the investment returns. It has noted to be having shortcomings. However, it is widely and globally accepted model. Moving on to the arbitrage pricing theory is a multi-factor theory. It is more flexible compared to the capital asset pricing theory and also more complex given it considers multiple factors. Moving on to the Farman French three-factor, it's adding two other factors to the risk factor such as size and value. The size is denoted as small minus big, where the investors they propose they demand for higher stock returns for low market value shares rather than high market value shares, and the value factor is denoted as HML, that is high minus low, where the investors they demand for higher stock returns for high valued shares rather than low valued shares. So there are moving on to the Carhart four-factor model, where you're adding another factor known as momentum that basically explains or describes a propensity of the stock performance within a specific time period. So there are certain anomalies to be pinpointed, and that is why it led to the emergence of the Farman French five-factor model, adding two more additional factors, that is investment and profitability. So it has penetrated internationally into the international markets, and now the model was considered effective as a failure because it failed to capture the low average returns of the small stocks. So I've conducted certain regression analysis to further support the theory. Now, the multi-factor models discuss up to 50 variables. However, given the time limit, I will be explaining three. So the macroeconomic factor models, they consider the economic variables to best describe. For example, would be the risk factor to examine the asset returns. So they consider, or the surprise factor is considered as the beta of the model. So we are moving on to the second type is a fundamental factor models, which consider the asset class specific variables such as the price to earnings ratio, the financial leverage, the market capitalization, and so on. The main difference between the multi or the macroeconomic factor models as well as the fundamental factor models is that in terms of the regression analysis method. The third type is the statistical factor models, which basically employ various variables along with statistical techniques to choose the most appropriate historical returns to best explain the stock or describe the stock returns. So one operational or one factor that is not described by the asset pricing model is the pandemic. The outbreak of the COVID-19 as an operational risk factor has affected the business operations drastically. The GDP has been shrinking throughout, and it is important for us to estimate the long-term effects and the severe consequences of this particular pandemic. The economic factors that affect the asset pricing theory, it is usually undeterminable. However, in this case, it's pretty clear the pandemic, and although the future contingencies has risen, the uncertainty is high right now. It is important for us to consider the short-term effects to be. It's considered more important rather than the long-term effects, stay for 3 years. And also the variations in the stock market also could be due to other factors such as the discount factor. So it's important for the policy makers to consider or determine the appropriate asset pricing model to best explain asset returns. Second CAF explains about the types of passive equity portfolio management strategies as well as the base of selecting ETFs. Now, moving on to the type of passive investing strategies, we have indexing, that is when the investors they replicate and they hold a wide index or indices such as S&P 500. Secondly, we have full replication strategy, which is basically utilized in order to minimize the tracking errors as for those securities that are held in proportion to their weights. It is basically, for example, I would say that an ETF, a fully replicated ETF tracking FTSE 100 positions would mean that they're holding all the 100 positions within that particular benchmark index. Thirdly, we have sampling. It's only holding only a portion of those equities within the particular benchmark index. Fourthly, we have quadratic optimization that involves the use of historical correlations that are basically input into computer application in order to track the performance of the indexes, and however the values are not so accurate. Lastly, we need one of the reasons why the passive ETFs are more in demand is because it's of its least cost compared to the actively managed ETFs. Now, there are certain factors to consider when you're selecting the ETFs. One could be the category of the ETFs, the US cap, European index, large cap, small cap, and so on. Then secondly, you have to consider the dividend expense ratio. Thirdly, you have to consider the credentials of the ETF providers. And fourthly, you have to consider the efficiency of tracking the underlying assets. And lastly, of course, you have to consider the distribution of the income and so on. Now, for the accurate results, you can also consider the intraday net asset value. It is basically to evaluate the value of the asset throughout the day. I've calculated for Vanguard S&P 500. It also has an expense ratio of 0.3, which is pretty low. That's pretty good. So if the market price of the ETF it exceeds the intraday net asset value, then there's a mispricing. The exchange traded funds are traded at a premium, and such mispricing are basically utilized by the investors as they buy and sell simultaneously until the ETF market value or the price it basically matches the intraday net asset values. So when selecting the ETF, you have to consider the benefits as well as the challenges faced by ETFs. Some of the challenges would be the size factor, the level of the risk, the information asymmetry, the credibility of the ETF providers. It could be the tracking error or the ability of the ETFs would be. The third graph mainly explains about the impact of COVID-19 pandemic on 5 different sectors. So I'm starting with the travel and leisure sector. Has both negative and positive impact. So it is the obvious reason of negative impact is that the people travel less. There were travel bans, lockdowns. The airline industries, they suffered huge losses. Now, it has a positive impact because there was increased in the transport of medical supplies from foreign countries, and even also the online leisure activities also flourished, targeting the children. So moving on to the healthcare and service sector again has positive as well as negative impact. Positive impact is mainly because of the increased demand for the medical supplies such as masks, gloves, sanitizers, disinfectants, and so on. Also the treatment for the infected people have also increased. Yes, the negative impact would definitely be the people not buying non-essential or life-threatening products and services such as dental care and cosmetics and so on. Moving to pharmaceuticals and biotechnological sector it has a positive impact, mainly because there was an increase in the investment in medical research. Negative because people opted for not buying non-essential products and services. There was even a difficulty of traveling and also shortage of drug supplies. Life insurance sector has purely negative impacts because of the debt toll increasing. The insurance companies had to cover the expenses for the insurers. The insurance company they omitted a target group of customers of a particular age, mainly the aged ones and so on, and the requirements for applying for insurance was also more harder. In the electricity sector has both positive and negative. Negative because the offices were shut down. It was not operational, so there's no electricity consumption there. But for the home, the electricity consumption increased because people resort to teleworking, working at home, use of online commercial sites for purchasing, children using electricity for leisure purposes, and the electricity consumption through home appliances, fridge, washing machine, and so on. So I've taken one company from each sector, and I've calculated the abnormal return T statistic as well as the cumulative abnormal returns, and it has supported all the facts I just mentioned. The healthcare service sector is expected to flourish after the lockdown, and also the demand for the research also may increase after the pandemic, the quarantine. The fourth CAF is a reflective piece on the simulation. Now, the simulation is altogether a new experience. Learning any concept in a practically as well as theoretically are two different things. So I was lucky enough to experience the practical sense of forex market. My group was assigned as a corporation, and my main objective was to get as many trades as possible. So throughout the simulation, I was very scared, but then as I made more deals, I was more confident. Now, for my trading strategy, I kept myself updated with the interest rate fluctuations, the interest rates, and I used it to convince the bankers with the particular rates, as the bankers themselves were confused, especially during the first 2 hours. That was amazing. And in terms of the market view, I consider the Japanese yen in terms of the British pounds, where Japanese yen was appreciating in terms of British pounds, because Japan was considered a tax haven, lesser unemployment, and more better circumstances, but in contrary to the UK. AUD in terms of USD was definitely depreciating, because AUDs was completely dependent on the energy, and the pandemic affected the energy prices drastically. So AUD was depreciating and USD was doing comparatively better. Towards, like, I feel like with the cure of the pandemic would just appreciate both USD as well as AUD. And also the country, what I personally feel, the country that finds a cure will also be, that particular currency will also appreciate. I enjoy the simulation amazingly. I did have certain team member problems, but I feel that is quite natural in a teammate. I feel I should have voiced my opinion a bit more confidently. That would have changed the situation a bit more. But I felt it was a splendid educational experience altogether.